Course, it's been nearly a week since the budget dropped. Many analysts are of the view that the economic assumptions are conservative. In contrast, Paul Ashworth, author of that chart from Cameron Harrison, thinks that consumer spending assumptions are too optimistic. I can see you there joining us via Skype. So welcome to the program, Paul. Do you think people are going to sit on all this money?
Well, I think as you introduce that, the assumption is that they will consume, because that's a developed economies graph, very much dominated by the United States. We don't think it's that certain that it will be spent. And I think understanding where a lot of that savings now sits, it actually sits in mid to higher income households that have a higher propensity to save than to consume. And I think the major part to that is that in terms of all of this stimulus, and it is somewhat in the Commonwealth government budget papers, is that private final demand doesn't look that great, from 2023 outwards. But there is a big positive. And the positive is that we see that potentially goes into market risk assets such as equities and property, together with some saving and some consolidation in debt.
So, Paul, putting that in perspective, if we don't have consumption really roaring, we're not going to go and see quite a strong economic recovery more broadly. So, does that mean we're going to go and return to the post-COVID era when we have quite sluggish growth and very low inflation and wage growth?
I think that's the risk here. So we're throwing everything, including the kitchen sink, in this pursuit of good economic growth. As you were saying, before, to your previous speaker, this pursuit of employment growth, feeding into wages growth. I think it will be potentially quite difficult. And as we've noted here, that assumption that this will get spent doesn't seem to be flowing out through when you have a closer look at the data. And it runs a real risk of that type of melee in terms of growth and wages outcomes. But as we've seen in particularly the post-GFC world, it's been particularly good for market risk assets.
Yeah, exactly my question, because as you know, it's not a zero-sum game. This savings ends up somewhere in the system. So does that mean that the business sector might do better out of the recovery rather than just buying stuff? Well, we saw, from the post-GFC environment that businesses curtailed investment. And we're seeing a little bit of the implications of that at the moment in terms of significant demand for input materials, and there is scope for some of that to go into further investment if we are going to get this continued stimulus. That is going to very much require the attitudes of governments to keep on spending, but not in this continued support of households in terms of transfer payments. But there is some scope for businesses who have underspent over the last 10 years. And in terms of a follow-up, maybe one reason consumers may not spend is this does feel temporary. However, if we bring forward, for example, the stage 3 tax cuts and benefits seem more permanent, do you think that might get people spending these windfalls?
Well, I think Tim Pallas's announcements in terms of indirect taxes in Victoria are perhaps a little bit of an insight as to what may need to occur federally in terms of those stage 3 taxes. I think we're seeing perhaps the Pandora tax box being slightly opened ajar, and I think those tax cuts are looking fairly precarious.
Pulling it all together, the macro environment we're looking at the moment, the conversation has been dominated by inflation and whether it's going to be sticky or not. How are you playing it from an investment perspective at the moment? Because it is offering up opportunities for those who want to go and position for one or the other.
Yeah, look, it's it's very clear that there is strong EPS growth, and we're seeing that particularly in the US. We're starting to see it here. In terms of those cyclical, if you like, those economically leveraged businesses. Inflation. Do we think that inflation, in a bigger sense, is a huge problem? I've said this before. We take a slightly jaundiced view of that. Developed markets are principally service-based economies, and if we look at something, if we look at the US in terms of its industrial inputs, excluding oil and gas, that amounts to something like $82 billion. On a finished product basis, that's $710 billion. Big numbers, but we're talking about the US economy, which is a $22 trillion economy. So again, we're not convinced that these input prices in these heavily serviced economies are going to have that ultimate pass through. And as we've been saying, the ultimate pass through is in terms of wages growth. It seems difficult. As for money supply, yes, it's certainly elevated, but we've had elevated money supply levels over the last 25 years. It's proven to be a pretty poor correlator to breakout inflation. So again, it's a net positive for risk assets.
Well, you've just spelled out a compelling picture for interest rates on hold till 2024, which is the RBA's view as well. So thank you so much for your thoughts today, Paul Ashworth. Cameron Harrison, thanks for joining us.
Pleasure, guys. Have a good day.